Hi everyone, and thank you for joining us today. For those of you who did not manage to join the first webinar in this series, my name is Joe Stadel. I'm a member of our client strategies team here at Research Affiliates. It's my pleasure again to host today's webinar on ignored risks of factor investing, which is based on a recently published research paper Vitaly and some of our colleagues have done back in October. This is the second in the series of 5 webinars that we plan to conduct over the next few months. In this series, we'll explore a broad array of educational topics. The first in the series was what matters in factor investing. And today, as I mentioned, we'll focus on the ignored risks within multi-factor investing. The third and fourth webinar in the series will focus on the most important issues around portfolio construction. And last, we'll look at integrating ESG considerations. For those who have dialed in today, who don't currently receive our research and would like to, you can register via our website at researchaffiliates.com. Or as you can see on the screen, you can follow us on Twitter or LinkedIn. I'm pleased to have welcome back Vitaly Kolesnik, head of our Europe research based here in our London office. Vitaly has contributed enormously to our factor research over the many years. Vitaly, this is an interesting title as it really looks more at the dark side of factor investing. In fairness, I've heard frustrations from a number of investors who find strategy providers only like to talk up the benefits of multi-factor investing, but don't give the risks involved and the potential for underperformance. I'm sure many on the call are interested to hear your views on this.
That's exactly the reason why we went into this study. We hear quite a bit of marketers talking about the benefits of factor investing, and we hear very little about risks of factor investing. And my opinion, and I've done this research together with Johanni Maya, who's working with us at Research Affiliates, and he and I have recognized over a long time looking at factors that factors come with very specific baggage of risks. And investors should realize head-on what kind of risks they're facing when engaging in factor investing. Now, talking about factor investing, it's my strong belief that factor investing has very strong benefits for investor portfolios. And we've touched in the previous webinar on a lot of this. This would be transparency, exposure to robust sources of returns, potential to lower the management fees and transaction costs. So that's all great. But the problem is that marketers are happy to advertise the benefits of factor investing, and there is very little talk about the potential risks of factor investing. And what we find is that factors have large drawdowns. Factors can have long periods of underperformance. Factor return is not normally distributed, which again makes the drawdowns worse than investors would otherwise expect. And then finally, diversification benefits, which are frequently emphasized, have limits. And so even when investors are invested in a diversified portfolio of factors, the diversification is still far from perfect. Now, on this slide, what we're showing is what marketers frequently show, which is the long-term performance of factors. And these are long-only factor exposure where we essentially target 5% tracking error. And you see that in all of these factors, there is pretty solid value add. Information ratio is positive in almost all of the cases. And in all of the cases, the Sharpe ratio looks quite attractive. And when portfolio of 6 factors, we're looking at 6 factors here, the value, momentum, low beta, investment, profitability, and size, when the portfolio of these 6 factors is formed, we get even more attractive information ratio, very solid value added, and that's very good. By the way, the reason why in the combination we see such a big improvement in terms of, for example, information ratio is coming from this low correlations between factors. So on this slide, we're showing the correlation metrics of the value add of various factors. And you can see that these correlations are pretty low. the average correlation is 0.05. And if you were to compute the absolute values of correlation, they're on average about 0.2. So factors are not very highly correlated. And so what marketers and what investors kind of conclude from looking at the data is that combine a number of these factors and you're almost guaranteed to have outperformance.
So, Vitaly, to play devil's advocates, I guess you could say that the '07 quant crash was a good example of correlations breaking down and really factors starting to co-move together.
Absolutely, and and the example that you just made, the quant crash, is just one of the examples where assuming the stability of this correlation metrics is dangerous. And even quite recently, we had another example in October of this year where a number of factors behaved in a correlated manner. So what about risks? So today we'll focus on relative performance to the market. Relative performance to the market is extremely important because it's the performance that helps investors stay invested through a course, and this part is very important for investors to continue stay invested in and multi-factor strategies to be able to benefit from the premia. And often, in terms of relative performance, the metrics that investors are looking at is tracking error. But tracking error is not a risk. When the strategy is outperforming, the higher your tracking error, the better it is, right? So when you're lucky, tracking error is good. It's when you're unlucky, that's when you're uncomfortable. And so tracking error is not risk. What matters for investors is periods of underperformance. And so what we'll be looking at is the drawdown relative to the market. And what we'll do is we'll first characterize the performance assuming that strategies are well behaved. Basically, that just for the lack of better information, it's natural to assume that things are quite normal and that we're unlikely to see very poor realization. So a lot of our intuition about day-to-day randomness comes from normal distribution. So for example, the height of people in the crowd or weight of people in the crowd would be normally distributed, and majority of the people in the crowd would be about average. And at the same time, you'd see some deviations from the average, and the bigger the deviations, the less frequent those deviations are. So the first exercise that we do is we calibrate the factor performance, assuming normality, and we simulate millions of 55-year-long strategies of performance. So we start with value strategy, where we take the value add and the tracking error of value strategy, assume normality, and what we are showing here are what would be a typical first, second, and third worst drawdowns in a 55-year period look like. And first thing that should jump into your eyes is that, the worst typical drawdown is about 25%, and the peak to recovery time is about 20 years. So if you are a value investor and you're running a portfolio with about 5% tracking error, you should be expecting about 25% worst drawdown, a typical worst drawdown in a 55-year period. The second drawdown should be about 15%. The third worst drawdown should be about 11%. And they should last about 10 and 5 years too. So you should be ready to bear quite material underperformance and lasting for quite a long time. Momentum. Again, we see quite similar picture where with momentum calibrated to the actual performance, what we see is about 20% worst drawdown, about 14% second worst drawdown, and about 11% third worst drawdown. These are big numbers, and the worst one should last about 14 years, the second should last about 8 years, and the third should last about 5 years. That's again long time. So these are the risks that you should be expecting. This is typical of factor performance, and that's what you should expect from just randomness. And of course, these simulations were done assuming normality. And at the same time, many things could be non-normally distributed. So, for example, if a basketball team comes into a crowd and they will just visually stand out in a crowd, and the return of the height in this crowd would no longer be normally distributed. You would see quite big outliers. And what we see with factor performance is that factor performance is also non-normally distributed. Extreme realizations are actually quite likely. Some factors like momentum or profitability in small cap space exhibit quite strong negative skewness. Negative skewness means that you actually should expect crashes for these factors. And then for all factors, they exhibit fat tails. So actually extreme outliers both on the positive and negative sides are quite likely. So what we show here, for example, are the worst monthly return realizations in this period, 63 to 2017. And then in the last column, we show how frequently you should expect some of these realizations if you were to assume normality. For example, if you were to take momentum, the negative 9.9% monthly return, well, you should expect it if a return were normally distributed about once in 19 billion years. Well, the universe itself, the age of the universe from the Big Bang, estimated by physicists, is 13.8 billion years. That's less frequently than once in a lifetime of universe, yet we've seen it in the last 55 years. If you look at momentum in small cap or momentum in profitability, well, before doing this research, I didn't even know how to name some of these numbers. So 10 to 15 is 1 in 340 quadrillion years. And for profitability, it's 1 in 622 septillion years. That's what these numbers mean is that they're unlikely to occur in our universe, period. And yet we've seen them in the last 55 years. And even when we get to a mix of portfolios for the 6 factors, we've seen the worst monthly realization of negative 8.7% return. And if we were to assume normality, we should see this number about once in 117 million years. Dinosaurs were wiped out about 65 million years ago. So 117 million years, the risk of factor investing were very low on our ancestors' priority list, and running away from Velociraptorus and Tyrannosaurus rex was probably much higher on the agenda. And yet we've seen this return realization in the last 55 years.
So Vitaly, if I think about this in another way, we're really trying to look at, how we expect factors to react if we're in an assumed rational, well-behaved market, and we're comparing that against how they actually behaved historically, and the difference between those two is actually pretty stark.
Exactly. So the things are, if we were to assume that things are well-behaved, we are shortcutting ourselves and we're setting ourselves for failure. Things are not very well behaved. Now, what about drawdowns? So when we are looking at realized drawdowns compared to the simulated typical drawdowns, now we start seeing, so here on this table, we show for United States, Europe, developed, and Asia Pacific ex-Japan, the simulated performance calibrated from the numbers using normal distribution, and then actual realized performance. And we marked with red ones where realized is worse than simulations. And you can see that there is a lot more red than 50-50, that's what you expect by randomness. And so what that means is that because of that non-normality of return, the realized drawdowns are significantly worse than simulated. Now, when we're looking at duration of these drawdown periods, we start seeing actually quite some peculiarities. So, for example, when we look at value, we see that peak to trough tends to be quite about matching in the length compared to the simulated drawdowns. But then when we are looking at recovery periods tend to be pretty short. And so what that means is that value historically has experienced these pretty fast recoveries. And that's pretty important for investors to realize to benefit from value factor. Momentum may be a little bit the opposite. So again, we see quite a bit of the red here on the top panel. What that means is that realized drawdowns are significantly worse than what you would expect from normality. And also what you see is when you examine duration, very frequently what you experience is that peak to trough is quite short. You don't always see it, but you see it very frequently. And so this is just a reflection of the momentum crash risk. So momentum is like collecting pennies in front of a steamroller. Most of the time you're doing great, but from time to time you get run over. And if you're not prepared to this behavior of momentum, you're again setting up yourself for a failure.
So Vitaly, that's quite interesting. So value tends to recover very quickly after long periods of underperformance, and momentum experiences these very sharp crashes. That has to make timing these factors quite difficult, especially for institutional investors who have much longer decision cycles.
Correct. And so timing, especially for institutional investors, is very hard. So, for example, value in the current environment has been underperforming for 10 years, and some investors think, oh, well, it's very risky to get into value. I'll always get into value when it will start outperforming. Well, the fact that value tends to recover quite fast can mean that by the time when you're ready to jump into value, a lot of the opportunity is gone. So the very practical lesson for many investors is that it's actually good to continue being diversified among factors and to have a very solid rebalancing scheme, kind of bring the mix to more or less equal weighted or whatever your preferences are in terms of long-run factor allocations. And maybe adding a little bit of over-balancing is actually good, favoring a little bit cheaper factors. But just having that discipline is going to be significantly better than trying to time it and avoiding value because it has underperformed and hoping that you will be able to jump on the bandwagon when it will start showing signs of better performance. Now, what about combination of factors? So we've seen quite low correlations, and when we assume normality and we run the simulation based on historical value add and tracking error of multi-factor portfolio, we get quite attractive numbers. We still see 10, 13, 10, and 8% drawdowns, but the duration is quite short, 5, 4, 3 years. So if you can recover from it very fast, that's not a big deal. Well, that was in theory. When we compare the normally distributed simulated performance versus the realized ones look actually quite more sinister. For example, if the typical drawdown for US was 13.2%, the realized worst drawdowns in the last 55 years was 18.7%. And if you look at duration, the duration is also longer, and furthermore, the peak to trough periods tend to be shorter, and the recovery period tends to be longer. Interestingly, that worst period is when we have not even recovered yet from the worst drawdown realized in the last 55 years. So what that means is that limits to diversifications have their own. There are strong limits to diversification. Diversification benefits are there, but they tend to be overstated. Investors would be well prepared to benefit from factor investing, assuming that at bad times the factors will start being correlated and may go down together. And preparing for that is extremely important for investors to benefit from factor investing. So Concluding, multi-factor investing has tangible benefits. So exposure to factors with evidence of premium is good. Low transaction management costs and transparency are all good features which will benefit investors. But investors, to benefit from factors, should realize that they're not collecting free lunch. They're getting exposure to risks. For example, value tends to have long periods of underperformance followed by potentially quick recoveries. And momentum is the opposite. Momentum is prone to crashes, kind of like collecting pennies in front of steamroller. And diversification benefits are limited, which means that investors should be expecting that when things start going south, they may see many factors going down at the same time. So investors should be expecting bumpy rides to be able to benefit from factor investing.
Thank you, Vitaly. I think we are running up on time for today's session, but I think we've got a time for one or two questions. So here's one from the audience. Could we not look at tracking error to give an indication of underperformance in a factor strategy?
So again, tracking error is a way to estimate how different a strategy is from the market. But what matters in the end is drawdown periods, and so tracking error is a good gauge of the concentration of the portfolio and how far away you are deviating and how aggressively you're taking factor exposure. So the drawdown risks, the length of the drawdowns does not generally differ much with the degree of tracking error. So choosing between different levels of aggressiveness of factor exposure will not you will not control the length of underperformance. But what you will control for is the magnitude of underperformance. So if you feel that 5% tracking error, so we've seen in this simulation that 5% tracking error would result in about 20% worse drawdown in 20-year period. Well, if you're uncomfortable with this level of underperformance, then scaling down on the aggressiveness and looking for smaller tracking error, you will mitigate the magnitude of that underperformance and would make yourself better prepared to weather through that underperformance.
Okay, great. Well, actually, we are out of time for today, but for all the other questions that we've got in, we'll take these offline. We'll get back to those viewers with a response. Thanks very much, Vitaly, for taking the time and for helping us with today's webinar. For everyone online, there will be the next webinar in the series will be next month. So please look out for the invite and do join us again for the next webinar in the series. Just as a recap, the replay for this webinar will be available on our website at www.researchaffiliates.com. You can see it on your screen. For those of you, again, if you would like to subscribe to our research, please do so on our website. You can also follow us on Twitter and on LinkedIn. I'd just like to thank everyone who's joined us today. We really appreciate you giving up your valuable time. Just before you go, there's going to be a very short, quick 1-minute survey. We would really appreciate if you could give us your feedback and your impressions of today's webinar. That really just helps us to be able to improve and make these more useful for you in the future. So thanks again for being with us today.